All right, let's just jump right in. What we're talking about today is, well, it's one of the boldest, most controversial, and frankly, most watched financial experiments happening right now. We're looking at a strategy that takes the old rulebook for how a company handles its cash and just completely shreds it.
You see, this isn't just about making an investment here and there. No, this is a fundamental re-engineering of a company's entire financial structure. They've turned their balance sheet into a machine with one primary goal: accumulate as much Bitcoin as humanly possible, basically forever.
So, how are we going to break this all down? First, we'll look at the revolutionary bet itself. Then, we'll dig into the problem it's trying to solve, the whole fiat currency issue. Next, we'll cover this wild idea of Bitcoin as digital energy. Then, we'll get into the nuts and bolts of the capital engine, see how this changes the company's stock, and finally, we'll talk about the endgame and the massive gamble it all represents.
Okay, first things first, the big question everyone asks is why? I mean, why would a totally successful, stable software company suddenly decide to go all in on what is arguably the most volatile asset on the entire planet? It seems crazy on the surface, but it's all built on a very, very specific view of the world.
And that worldview really begins right here. This entire model, this whole grand experiment, it's a direct response to what they see as a deep structural flaw in our traditional financial system. So this isn't about chasing gains. It's about escaping a system they believe is fundamentally broken. The core problem, the big villain in the story, is something called fiat debasement. The idea is simple. Central banks are basically programmed to expand the money supply over time. It's not a temporary thing, it's a permanent feature. So if you're a company holding millions in cash, your treasury is basically a melting ice cube. It's guaranteed to lose purchasing power every single day. And this slide really lays out the choice they see. On one side, you've got your standard currencies, which they frame as a liability. Its supply just keeps expanding, so its value is guaranteed to decay. On the other side, you have Bitcoin, presented as a hard asset with a fixed, provably finite supply, only 21 million ever. The argument is that this digital scarcity is the only real hedge against that guaranteed decay. And this quote, this just perfectly sums up the entire risk calculation. You know, the wild price swings of Bitcoin, the volatility, they see that as something you can stomach. It's a short-term headache for long-term gain. But the slow, steady, guaranteed bleed of value from holding cash, that's seen as a terminal disease. There's no coming back from that. So this worldview leads us to the next really critical piece of the puzzle. It's about completely reframing what Bitcoin is. To justify putting all your eggs in this one volatile basket, you have to stop thinking about Bitcoin as money you use to buy a coffee. The concept here is way more abstract and way bigger. They call it digital energy. And think about it like this. All the work we do, all the productivity, all the value we create, that's a form of economic energy. The question is, how do you store that energy for, say, 10, 20, 50 years without it leaking away? The argument is that Bitcoin is like a perfect battery for that energy, preserving its value across time and space without dilution. So what makes this monetary battery so special? Well, it all comes down to these properties. The finite supply is, of course, the big one, but it's also that it's purely digital. You can move it, split it up, and check it almost instantly. And that last point, unforgeable costliness, that's so important. Because it takes a massive amount of real-world energy to mine a Bitcoin, its value is physically tied to that cost. You can't just print more of it. Okay, so we've got the why, escape fiat decay with a digital energy asset. Now, let's get into the how. How does a company actually transform its balance sheet into this perpetual Bitcoin buying machine? It's actually a pretty simple but incredibly powerful three-step loop. Step 1, you take all your extra cash and buy Bitcoin. Step 2, you go to the capital markets and raise more money, usually by taking on debt. And step 3, you immediately use all that new money to buy even more Bitcoin. And then you just do it again and again. It's an engine designed to do nothing but convert what they see as a fiat liability into a hard asset. Now, the logic behind this is what's called a synthetic carry trade. It's a classic financial move just on a whole new level. Basically, you're borrowing money at a low interest rate, say 3 or 4%, in a currency you believe is getting weaker. And you use that money to buy an asset you believe is getting stronger way faster. The entire strategy lives or dies in that gap, the bet that Bitcoin's price goes up way more than the cost of the debt you took on to buy it.
So, as you can imagine, this pretty radical treasury strategy has a huge effect on the company itself, especially on its stock. It stops being just a software company in the eyes of investors. It becomes something else. The company's stock basically becomes a proxy for Bitcoin, but with a major twist. It gives big investors a way to get exposure to Bitcoin through a regular stock they can actually buy. But here's the kicker. Because the company uses debt to buy its Bitcoin, it creates leverage. And that means the stock's movements become an amplified, high-stakes version of whatever Bitcoin is doing. And this table shows you exactly what that looks like in practice. If Bitcoin goes up 10%, you'd expect the stock to go up by more than 10%. That's the beautiful upside of leverage. But, and this is a big but, it cuts both ways. If Bitcoin drops 10%, the stock is probably going to fall by more than 10%. It just magnifies everything, the gains and the losses.
So where is all this headed? What's the end game? Because this is about more than just one company's balance sheet. There's a much bigger vision at play here, but it is built on an absolutely massive gamble. The ultimate goal here is to basically kickstart a new era of corporate finance. The vision is a future where companies all around the world stop holding cash that loses value and instead use Bitcoin as their main reserve asset. This would, in effect, anchor the entire corporate world to a hard, deflationary asset, kind of like the old gold standard. But, and this is critical, for any of this to work, two things have to be true. First, Bitcoin's value has to keep going up faster than the dollar's value is going down. That's the whole bet. And second, the company has to be able to keep borrowing money cheaply. If interest rates shoot up or investors get scared, that whole acquisition engine could just seize up overnight. So, if you strip it all down to its core, you can think of this whole strategy as a kind of rocket ship. It's trying to build enough thrust to escape what it sees as the gravity well of a financial system that's always inflating. And Bitcoin is the rocket fuel, chosen because it's seen as being anchored in math and physics, not the whims of a central banker. Which leaves us with the big question, doesn't it? Is this the work of a genius, a visionary creating the blueprint for how all companies will work in the future? Or is it an unbelievably risky gamble, a cautionary tale of leverage and volatility that's just waiting to blow up? The honest answer is nobody knows for sure. But you can bet the entire world is watching to find out.